Traditional technical analysis frequently fails during volatility spikes because real-time dealer hedging completely overrides historical chart levels. In institutional derivatives trading, we map the actual physical barriers in the market using gamma exposure data. Gamma exposure, or GEX, is a metric that measures the sensitivity of options market makers' delta hedging requirements to changes in the underlying price. Currently, the S&P 500 options market, specifically the SPXW, is trading at a spot price of 6,477.16. We are operating in a deep negative gamma regime. This GEX report shows extreme positioning asymmetry. In the expected intraday range section below, downside distance to the put wall is negative 0.4%, while the upside gap to the nearest call node stretches to positive 8.1%. This skewed range is mathematically dictated by the massive negative $84.99 billion of spot GEX per 1% move. In a negative gamma regime, dealers are structurally net short options. To remain delta neutral, meaning their overall position is protected against small price movements, dealers must hedge procyclically. They mechanically sell the underlying asset as the market falls and buy as it rises. This forced hedging acts as the true engine of market momentum, amplifying volatility and dictating the pace of intraday moves. We will deconstruct the data in this GEX report to map the true intraday topography, isolating the specific put walls, call nodes, and gamma cliffs. Intraday support and resistance represent dynamic, physical zones of required institutional liquidity. This chart displays the full chain GEX profile. It tracks the transition from the red negative area to the positive area. On the net $GEX y-axis, see how deep into negative territory spot sets. The orange line marks the gamma flip at 6,673. The gamma flip is the structural boundary between volatile, amplifying negative gamma conditions and stable, dampening positive gamma conditions. It requires a 2.9% rally from the current spot price to reach this stabilizing flip zone. These specific data tables shift our focus from the broad regime to the concentrated gamma at individual strikes, defining our hard support and resistance. The dominant put wall sits at the 6,500 strike, containing an overwhelming negative $6.3 billion in gamma. This put wall acts as a pin strike. Because dealer hedging requirements peak here, it creates a massive physical floor for the underlying price. Contrasting this downside support is the upside ceiling. The nearest positive GEX node rests far above at 7,000, holding positive $2 billion. Because dealers are forced to trade heavily around these specific strikes, index prices close inside these two structural boundaries roughly 78% of the time. What happens to market structure when the underlying price breaks through a massive put wall? We hit the gamma cliff. Today, the steepest drop in GEX occurs exactly at 6,477. A break here triggers a threshold where technical support levels are violently overrun. As price drops past the threshold, second-order Greeks take over and accelerate the market's momentum downward. The primary driver here is speed, which measures how quickly gamma fluctuates as price approaches a pin strike. When we near these concentrations, dealers adjust hedges at an exponentially faster rate to maintain neutrality. Simultaneously, the Vanna effect links price movement to implied volatility. In a sell-off, volatility spikes, causing the delta of put options to expand. This expansion forces dealers to sell even more of the underlying asset just to keep their net delta exposure from growing. The overlap of these two forces creates a feedback loop. Speed demands faster selling as we approach the strike, while Vanna demands higher volume selling as volatility rises, compounding into a self-reinforcing downward move. This section of the GEX report maps out the specific break cascade sequence from these mechanics. Look at point 3 under the key takeaways. If the 6,500 level breaks, the flow directly targets the 6,400 wall, then bounces to 6,475 and drops to 6,300. Each broken put wall triggers a new wave of forced dealer selling that mechanically feeds the downward momentum to the next level. Intraday crashes manifest as predictable mechanical cascades, triggered the moment price crosses specific GEX thresholds. We must shift our focus from the macro market structure down to the micro, intraday timeline. 0 days to expiry, or ODTE options, exert a massive intraday gravitational pull that alters the immediate market structure. This table provides a direct numerical comparison showing how ODTE flow distorts the full chain structure. Notice how the primary pin strike completely shifts, dropping from 6,500 in the full chain down to 6,400 for the nearest ODTE expiry. This ODTE pin strike creates its own isolated intraday center of gravity. Furthermore, the ODTE gamma flip drops to 6,556, acting as a tighter, immediate intraday pivot compared to the full chain flip. These short-term options introduce a powerful new force into the final hours of the trading session: charm. Charm measures the time decay of delta. As the closing bell approaches, out-of-the-money puts rapidly and mechanically lose their delta value. Because the puts lose delta, dealers must aggressively cover their short hedges. This creates a mechanical lift or sharp price compression in the afternoon. Standard support and resistance levels are constantly being warped intraday by the rapidly decaying gravity of zero DTE options. To navigate this environment, we combine all these independent metrics into a single, actionable trading map. We build our intraday topography model. The spot price is plotted at 6,477. It is bounded below by the zero DTE wall at 6,400 and the full chain wall at 6,500. Above it, we set the expiry FRUP at 6,556 and the full flip at 6,673. The spot price is trapped deep within a volatile negative gamma regime. Heavy downside gravity pulls the price toward the clustered put walls resting between 6,400 and 6,500. Reaching structural safety requires a steep upward climb across both gamma flips. Intraday price action is not random. It is a direct, measurable function of dealer liquidity provision and their mandatory delta hedging. In negative gamma regimes, market makers structurally amplify the prevailing trend, effectively removing the liquidity buffers usually found in stable markets. By pre-mapping put walls, call nodes, and gamma cliffs, a trader can anticipate exactly where liquidity will hold and where it will vanish to create breakout cascades. The core of market structure lies in the underlying mechanics of dealer exposure, providing a real-time map that historical price charts cannot capture.